Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market update, earnings, economic data, and fund flows. This video presents a direct informational narration of the source document. All right, let's jump right in. We're seeing the market rally broadly across all 11 S&P sectors today. This is being driven heavily by some really strong earnings reports hitting the tape, particularly coming from our industrial leaders. Here is what we're going over today. First, a look at the broad market overview and geopolitics. Second, we'll break down the key economic data. After that, we'll dive into earnings focuses on Apple and then Eli Lilly, followed by updates on Qualcomm and Microsoft. And finally, we'll wrap up by looking at retail versus institutional fund flows. So, Section 1, Market Overview and Geopolitics. Let's see what's driving the macro environment right now. According to a recent UBS market assessment detailed in our source document, this current environment is, quote, increasingly characterized by idiosyncratic adjustments, dispersion, and selective rotation, rather than broad beta exposure. What does that actually mean for us? Well, it indicates a highly tactical stock pickers environment. Strong individual stocks are the ones continuing to attract concentrated capital, rather than just a rising tide lifting all boats. Turning to the Middle East, we've got some conflicting geopolitical crosscurrents keeping Brent crude elevated above $110 a barrel. On one hand, we're seeing positive expectations about Iran submitting modified proposals, alongside talks of a potential coalition forming to reopen the Strait of Hormuz. But, contrasting right up against that, we have reports that the U.S. is weighing short-term military strikes on infrastructure to break the current standoff. It really highlights an ongoing active evaluation of military options. Moving on to Section 2, Key Economic Data Breakdown. Let's unpack the numbers. Looking at the March inflation data, headline PCE rose 0.7% month-over-month, bringing the year-over-year figure to 3.5%. Now, this was primarily driven by energy prices, but if we strip out food and energy to look at core PCE, that actually dropped to 0.3% month-over-month, registering at 3.2% year-over-year, and that aligns really tightly with what the market was expecting. Next up is first quarter GDP, which grew at 2%. That completely surpasses the 0.5% growth forecast we saw coming out of Q4 last year. Now here's an interesting detail. Fixed asset and housing investments actually fell by 8%, which dragged down net GDP by 0.31 points. So how did overall GDP expand? Well, artificial intelligence-related investments literally contributed a massive 75% of the total GDP growth. That's a huge underlying driver. And checking in on the labor market, the data showed a sharp and honestly unexpected decline. Initial weekly jobless claims dropped down to 189,000, well below the 215,000 that was expected. Meanwhile, continuing claims also fell significantly, landing at 1.785 million. All right, Section 3, Apple earnings focus. Let's talk about the tech giant's latest quarter. Apple came in hot, reporting earnings per share of $2.01, beating the $1.96 expectation, and posting total revenue of $111.18 billion. But the regional breakdown is where it gets really interesting. They actually had misses in the US and Europe, but this was completely offset by massive growth in Asia. Japan brought in $8.4 billion, which is up 15%. The rest of Asia saw $9.14 billion, up 25%. And Greater China experienced a massive 28% year-over-year revenue surge, hitting $20.5 billion. On top of those numbers, Apple just authorized a jaw-dropping $100 billion stock buyback program, along with declaring a cash dividend of 27 cents per share. This is backed by them generating over $28.1 billion in operating cash flow. Our source specifically notes that this rock-solid financial positioning reflects Apple's current strategy of deliberately not heavily engaging in these capital-intensive AI infrastructure races we're seeing elsewhere. Up next, Section 4, Eli Lilly earnings focus. This one is a real standout. Eli Lilly absolutely crushed expectations, posting a 56% surge in revenue to reach $19.8 billion. Adjusted earnings per share came in at $8.55. Because of this momentum, they aggressively raised their full-year EPS guidance range from previous estimates, pushing it all the way up to between $35.50 and $37.00. They also adjusted their full-year revenue expectations to a range of $82 billion to $85 billion.
Concurrently, S&P Global Ratings stepped in and upgraded Eli Lilly's issuer credit rating from A+ to AA-. The agency also maintained a positive outlook for the company, explicitly citing Eli Lilly's incredibly stable financial condition as the primary reasoning for the upward adjustment.
Moving to Section 5, Qualcomm and Microsoft updates. Let's see what's happening with these tech heavyweights. Let's start with Qualcomm. They delivered relatively flat immediate financial guidance for the third quarter, projecting EPS between $2.10 and $2.30, and revenue somewhere between $9.2 billion and $10 billion. But here's the kicker. Despite that flat trajectory, shares surged 15%. Why? Because the CEO made some highly optimistic forward projections during the earnings call. Specifically, he highlighted early data center chip shipments kicking off in the December quarter and noted an anticipated Q3 bottom in the Chinese smartphone market. Now, regarding Microsoft, our source evaluates the potential impact of those ongoing legal disputes surrounding OpenAI. Basically, if OpenAI is unable to IPO due to these legal hurdles, it represents a short-term sentiment headwind recording over $100 billion in unrealized valuation gains tied directly to Microsoft's stake. However, the assessment makes it clear that this poses minimal long-term disruption to Microsoft's core AI cloud service infrastructure. Finally, Section 6, Retail versus Institutional Flows. Let's look at who is actually moving the money right now. Looking at current market flow data sourced from Goldman Sachs, we're seeing extreme retail buying and momentum chasing. Everyday investors are diving in. Mutual funds are also buying aggressively, trying to catch up on their previous underallocations. But on the flip side, commodity trading advisors, or CTAs, are currently selling slightly. The data notes a massive liquidation trigger to watch out for. If levels break below 67.39, CTAs are projected to accelerate their selling, potentially liquidating 90% of their positions. That amounts to an estimated $40 billion to $50 billion hitting the market. So the source document concludes by raising a really critical question for forward-looking liquidity. As all these current buyers aggressively chase the market right now, what happens when retail investors and mutual funds fulfill their current allocation limits? Who is going to be the next marginal buyer stepping into this market? It's definitely something to think about.